Hey everyone, welcome back to Corporate Decoder, the place where we untangle the truth behind the jargon. Today we're diving deep into FST Corp's latest report, and let me tell you, it's a fascinating look at a company that's really trying to shape its future, especially after a big merger. Get ready because we're about to decode exactly what this means for them and for you. And hey, if you love getting these kinds of insights without the corporate fluff, make sure you're subscribed. We also have a fantastic community over on Discord, linked in the description below, where we chat about all things business and investing. So FST Corp, we're talking about an amendment to their registration statement filed back in July of 2025. Think of this as an update, a way for the company to tell the world, and more importantly, the SEC, what's happening with their stock. They've got up to 14,399 to 85 ordinary shares looking to be issued when warrants are exercised, and a chunky 35 ordinary shares looking to be issued when warrants are exercised, and a chunky 35 ordinary shares looking to be issued when warrants are exercised, and a chunky 35 on the one 84,834 ordinary shares looking to be issued when warrants are exercised, and a chunky 35 ordinary shares looking to be issued when warrants are exercised, and a chunky 35 ordinary shares looking to be issued when warrants are exercised, and a chunky 35 ordinary shares being offered by folks who already own them. The big story here is the business combination that wrapped up in January of 2025, essentially FST Corp, combined with another company called Chungha, which then became FST Limited. This kind of deal is common for special purpose acquisition companies, or SPACs, which exist just to buy another company. FST itself is a golf club shaft maker with a history going back to 1976. They've really built their name on the KBS brand. Now, FST Corp, or as it's now known, FST Limited, after the merger is trading on Nasdaq under the ticker KBSX. As of June 2025, the stock price was hovering around 1.56. It's important to note that these shares being registered now are mostly existing shares being resold by some shareholders and shares that can be bought when warrants are used. The company is a pioneer in the golf industry, making high-performance shafts for over 3 decades. They are a major player under their own KBS brand, also doing work for other well-known golf brands as an OEM. Think of it like making parts for other companies, but also selling their own branded products. Now let's talk about those warrants. These are like options to buy FST shares later with the price already set. There are 14,185 of them out there with an exercise price of $11.50. That means if the stock price goes way above $11.50, that means if the stock price goes way above $11.50, that means if the stock price goes way above $11.50, these warrants become valuable. But as of June 2025, the stock price was way above 11.50 cents. To be exact, so these warrants aren't helping the company get cash right now. Then we have the selling security holders who are looking to sell up to 35,184,834 shares. This is a pretty significant chunk of their shares, around 78% of the total shares outstanding at the time of the merger. This is important because if a lot of these shares hit the market, it could push the stock price down. A lot of these shareholders, about 78%, agreed not to sell their shares for 6 months after the merger. This is pretty standard to prevent a flood of shares right after a deal. When you look at the risks, they're quite extensive. One major theme is their reliance on the KBS brand and customer acceptance of their products. They also talk about potential production delays, costs, and the challenge of forecasting demand accurately. They have a limited operating history as a public company, which itself is a risk. They also highlight the limited experience of some of their management team in running a US public company. And there's a clear mention of liquidity challenges due to high leverage and funding needs. They're looking at selling non-core assets and issuing new debt or equity to raise money. This is a big red flag. It means they need cash to keep running and growing. Their business is tied to the golf industry, so a slowdown in golf participation or fewer rounds being played definitely impacts their sales. Pretty straightforward there. Now let's look at the financials after the merger, presented as if it happened at the end of 2024. The pro forma assets total about $58.6 million, but a big chunk of that, over $41 million, was held in a trust account during the SPAC phase and has now been released. Notice how that cash held in trust account of over $41 million is gone in the pro forma balance sheet, largely because it was released upon the business combination. Their total liabilities are reported at about $43.3 million. That's a pretty substantial amount, especially when you compare it to their shareholder equity, which appears much smaller. Looking at the operations for 2024, they had a net loss of about $3.2 million. This isn't great, but it's common for companies that are still growing and integrating after a merger. The company is making more money, with revenue up 27% in 2024 compared to 2023, reaching over $36 million. That's a good sign for growth. However, their gross profit margin actually went down. They attribute this to a less favorable product mix and higher unit costs because of lower production volumes. This is concerning because even as they sell more, they are becoming less profitable on each sale. It's like selling more cookies but making less profit per cookie. Their general and administrative expenses also jumped, mainly due to those business combination fees. Understandable, but it adds to the cost of doing business. They actually generated positive operating cash flow in 2024, which is a positive change from 2023. That's really good to see, though the overall cash flow from operations for the year was still negative, showing they're spending more than they're bringing in from their core business activities. Now, the tax section is really technical, but the key takeaway is that FST Corp doesn't think it will be treated as a US company for tax purposes after the merger. This is important because if they were, all their global income could be taxed in the US, which would be a huge burden. They're relying on complex rules to avoid this, but it's an area that could be challenged. FST's core business is golf shafts. They're a major player, especially with their KBS brand, which is highly regarded even by PGA players. Having 73 PGA players using their shafts in competitions is a strong endorsement and a great marketing tool. Their strengths seem to be their KBS brand, a vertically integrated business model where they control design, production, and marketing, and their R&D capabilities. They also benefit from Taiwan being a hub for golf equipment manufacturing. They're looking to expand their retail presence with more KBS Golf Experience stores globally. This helps them connect directly with customers, get feedback, and build brand loyalty. It's a good strategy to turn brand recognition into direct sales and profit. Scroll employees and human capital, they have 394 employees, mostly in manufacturing, sales, and marketing. It's good to see they have no work stoppages or employee disputes, which indicates a stable workforce. Scroll opinions of the consolidated financial statement opinion looking at the independent auditors report for FST Corp. The auditors at KPMG Taiwan are saying the financial statements present fairly, but they also mention substantial doubt about the company's ability to continue as a going concern. This is a serious warning, meaning they're not totally sure FST can pay its bills in the near future. Scroll opinion on the financial statement opinion. Key and for FST Limited. The SPEAK side before the merger, the auditors also had to include an explanatory paragraph about going concern. It seems both sides were facing significant uncertainty before they joined forces. So what's our take on all of this? FST Corp has a strong brand in the golf shaft market, and the merger with Changhei seems to have given them access to public markets. The revenue growth is positive. However, falling profit margins, liquidity challenges, and the auditors' warning about going concern are definitely red flags. They're relying heavily on future growth and potentially new financing to overcome these hurdles. Will their KBS brand and expansion plans be enough to turn things around and ensure long-term success, or will these financial pressures prove too much? It's a company to watch, especially how they manage their debt and the increasing costs. What do you think about FST Corp's strategy and financial health? Are the risks they face too great, or is there potential here? Let us know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more corporate deep dives. And don't forget to jump into our Discord community, linked in the description, to continue the conversation. Thanks for tuning in to Corporate Decoder. See you next time.